When someone approaches a millionaire with just $500 and asks, "What should I do with this?" they're really asking a much deeper question. How do I take something small, something that looks almost insignificant in the grand scheme of things, and turn it into the foundation of long-term wealth? The truth is, most people believe investing is only for the rich, that you need thousands or tens of thousands of dollars just to get started. But that belief is one of the biggest reasons so many never begin. $500 is not just money, it's momentum, it's a spark. And if you treat it with the seriousness and respect of someone building a future, that spark can grow into something you'd never expect. So if you came to me today and repeated that simple question, what do I do with this? I'd start by walking you through the same four-part framework that allowed me and many others to build wealth deliberately, steadily, and sustainably over time. The very first step is to stop looking for shortcuts. Stop hunting for magic. Stop thinking the wealthy know some secret trick. The most reliable path forward has nothing to do with guessing the next big stock or trying to double your money overnight. It begins with structure, with discipline, and with understanding the one financial force more powerful than talent, luck, or timing: compounding. And the easiest, cleanest, most beginner-friendly way to harness compounding is through a broad market index fund. I'd tell you to take the majority of your $500, roughly 75%, and put it straight into an index fund that captures the overall growth of a major market. Something like a total market fund or an S&P 500 index fund isn't glamorous. It doesn't flash. It doesn't promise overnight transformation. But what it does promise is participation in decades of economic growth. It gives you exposure to hundreds of businesses that have weathered recessions, crashes within crashes, wars, inflation waves, political shifts, technological shifts, and everything else the world can throw at them. And historically, despite all the chaos, the market has marched upward, slowly at times, rapidly at others, but upward. When you buy into an index fund, you're not betting on one company to dominate. You're betting on human innovation, productivity, and progress to continue. You're betting on the long arc of growth. Think of it as your financial soil, a bed of stability from which future wealth can grow. Once that foundation is in place, then, and only then, do we talk about growth. Every millionaire I know has at least some portion of their portfolio that reaches beyond the basics and steps into the realm of individual companies. Not in a reckless, pick a random trending stock and hope kind of way, but in a thoughtful, curiosity-driven, future-focused way. So I'd take a smaller portion of your $500, maybe 15%, and allocate it toward companies that genuinely interest you. This part is not just about money, it's about education. When you start owning even a fragment of a single company, you begin paying attention in a completely different way. Suddenly you care about earnings reports, new products, leadership decisions, long-term strategy, and how emerging technology shapes entire industries. You begin to understand why some companies thrive and others disappear. You start to see patterns. You learn to recognize innovation, not just hype. Investing in individual companies teaches you to think like an owner, not a consumer. Maybe that means investing in a company building groundbreaking AI models, or a hardware manufacturer powering cloud infrastructure, or an energy company reshaping how the world powers its future, or a firm pioneering medical breakthroughs. These companies may fluctuate more aggressively than index funds, but that volatility is not the enemy. It's a teacher. It shows you how markets move, how narratives shift, how patience is rewarded, and how emotion destroys portfolios. The goal here is not to gamble on miracles. The goal is to engage with the future. This slice of your money becomes your growth engine, your way of capturing potential upside without jeopardizing your foundation. But even the most well-structured investment plan collapses if you're not prepared for real life. And life, as you know, doesn't care how well you planned. Cars break down, jobs disappear, gut punches arrive without warning. Without a safety net, even a minor emergency can force you to panic sell your investments or rack up expensive debt. That's why I'd take 10% of your money and put it in a high-interest savings account, the kind where the goal isn't aggressive growth, but immediate accessibility, stability, and psychological peace. People underestimate how powerful it is to know you have cash available. Wealthy people understand this instinctively. They maintain reserves, they protect their future selves, they build buffers so their investments can keep compounding uninterrupted. This small savings portion might not feel exciting today, but one day, maybe months or years down the road, you will face a moment where that money prevents a setback. It prevents stress. It prevents your investment strategy from being derailed. And having that small emergency cushion is often the difference between people who stay on track and people who fall off the path entirely. Now, once the core pillars are in place, your foundation, your growth exposure, and your safety net, there's one final piece I'd recommend adding. It's small, only 5%, but it plays a very important role, your frontier investment. This is where you allow yourself to explore something more speculative, more forward-leaning, something that represents the cutting edge of technology or finance. For some people, this might mean dipping into cryptocurrency or blockchain-based assets. For others, it might be emerging tech platforms, digital ownership systems, decentralized technologies, or even experimental financial tools. The point is not reckless gambling or chasing trends. The point is exposure. The point is learning how new systems work before they become mainstream. Throughout history, people who studied new technologies early, even in tiny amounts, gained knowledge that later shaped major financial decisions. This 5% investment isn't about profit alone. It's about perspective. It teaches you to stay curious, to stay adaptable, and to recognize that wealth building is not just about preserving what exists, it's about understanding what's coming next. By limiting this category to a small piece, you protect yourself from major losses while still participating in the future. When you combine all four components, your index fund core, your selective growth investments, your emergency savings, and your frontier exploration, you create something far more powerful than a random collection of financial choices. You create a system, a strategy, a blueprint that mirrors how real wealth is built across decades, not hours. And what's most important is that this blueprint works regardless of how much money you start with. $500 is enough to begin. $1,000 is enough to continue. $10,000 is enough to accelerate. You don't wait until you're wealthy to invest. You invest so that you can become wealthy. You don't wait for perfect timing. You build habits that make timing irrelevant. You don't wait for permission. You create momentum with what you have. If you walked up to me, even right now, and asked again, what do I do with this? That is the roadmap I'd hand you. A plan that balances security with opportunity, caution with curiosity, stability with growth. A plan built not on hype, but on wisdom earned through time, mistakes, and real-world experience. Because the path to wealth isn't steep or mysterious. It's long, steady, patient, and available to anyone willing to begin with intention. If this video changed how you see investment, don't stop here. Hit like, share this with someone who's still scared to invest, and make sure to subscribe.